All right. Welcome back to the discount, everyone. I hope you're all having a great week. What an absolute face rip melt up we are having this week and the past several weeks. As you can see, I have the SPY weekly chart up and we are just on complete melt up mode. If you remember from last week, I said there's no reason to get in front of this rally right now. Let's wait for a sign or signal of a trend change. Perhaps over here, if you remember in August, see this candle right here on the weekly. Let's wait for something like that on volume to give us something to play the short side against if we even want to go short, right? Perhaps we will wait and see for a pullback, a significant pullback into perhaps the 414 level. And everyone's going to be thinking the market is absolutely over. People will be running around with their hair on fire if this market shows any sign of a pullback. Pullbacks are normal. Don't forget, we are in a bull trend right now. Until and unless we start getting below this trend line, in my opinion, we are in a bull market. And we could see some type of pullback into this 414 level right here. No problem. We are still in that uptrend. We want to see this break down here. Maybe we consolidate above this 430 level. Let's wait and see how the week closes. But again, just super impressed by this move in the market and would not be surprised to just go ahead and why not just tag it 786 retrace right here on the weekly. Same thing on the daily chart at 450 on the spiders chart. So today, guys, I want to prepare everybody for what we're going to be going over in the weekly newsletter. It is a 5-minute read, super simple, common sense investing and trading. And what we're going to be going over on Sunday night in the newsletter is the pound for pound recession predicting champion. That is the yield curve. Not too many people talk about this that just cover technical analysis, but the yield curve is super important and has predicted the past 10 recessions since 1950. This chart shows the S&P 500 and the yield curve when it inverted. As you can see, we have had an inverted yield curve since July of 2022. So we're coming up on the 12-month mark of how long the yield curve has been inverted for. The gray areas are recessions. If you take a look at the year 2000, you could see the inverted yield curve showed how big of a drop in the S&P 500. And as you can see, the yield curve predicts just how far down the S&P 500 can go after the yield curve is done inverting. Make sure to come on over to the website, subscribe on the website. It is 100% free, simple 5-minute reads every Sunday to get you prepared for the days, weeks, months, and even years ahead. Now, I don't want to spoil everything, so let's head on over to a chart that might be the most important chart for your investing future. This chart shows the 10-year yield on U.S. government bonds. As you can see, we broke out of this multi-decade downtrend, and obviously it is on the front page news. No one can buy homes with these interest rates, and that's because of this chart. The Fed went from historic interest rates in the COVID bust and melt up all the way to interest rates not seen since 2008. This is going to have a significant effect on the economy, which in return is going to have a significant effect on the stock market. So we're going to be covering all of that in the newsletter this Sunday. What I will tell you is what you can expect if we get some type of deflationary environment, deflationary event in the stock market indices. We should see this come back down to retest this breakout area in some fashion. Now, I don't know if it's going to be this area right here at about 2% or even lower into that 1% level where we were in COVID in 2020, but we should see rates come back down because the Fed is going to have to cut rates in the future when we get some type of deflationary event. What do I mean by deflationary event? As you saw with the banking crisis, and it's funny because it doesn't really seem like a crisis anymore, the regional banks were failing, they were getting bought up. European banks were failing, they were getting bought up. We're likely going to see some type of scenario. I don't know specifically what is going to drop, which shoe is going to drop, but we're likely going to see some major major bankruptcies because of these interest rate hikes. When you have downsloping interest rates for decades and then this sudden of a change, the economy is just simply not prepared for it. Now, economic indicators lag, and the Federal Reserve is not taking that into consideration. So when something major breaks again and there's some type of deleveraging event in the stock market indices, the Federal Reserve is going to have to come back and save the day. This should bring rates back again and the 10-year yield down to this 2% level. Do what you will with that information. This is not financial advice, but we will go over market performance after every single inverted yield curve this Sunday, rate performance after every single inverted yield curve this Sunday, and you'll be able to prepare yourself and your families for the weeks, months, and days ahead. Heading over to the stock market again, the S&P 500, the spiders chart. Let's just wait and see. If you are long here, congratulations for catching that long. We also have a ton of plays coming out as we look across these markets in the Telegram channel. The Telegram channel is 100% free as well. Here's one play. We were already up 100% on options. We called this out at the very bottom and said, this has the highest short interest out there and everybody hates this stock. We have 2025 call options to give it room. We let it ride to zero, or we get paid extremely handsomely. If it comes back up to this 100 level, we're going to be making a lot of money. Some other plays, we've called out commodity levels here. Look how handsomely wheat has bounced off this level so far. You could be taking profits at this point and letting the rest ride. Another play for the conservative investor, dividend yielding 3M. 3M came into a major level with room for downside. Of course, it can absolutely go lower. We go ahead and duplicate this. I'm leaving room for 3M to come lower, and it has a handsome 6% dividend yield. Very long-term trend line. It came off and bounced off this trend line. If we zoom in on the daily chart, here's the trend line. And we are already up about a handsome 10-12% on that play so far, depending how you played it. We even had a whopper of a day trade in the Telegram channel today. We were buyers of 436.45, give or take, and the thing ripped for the entire day. So come on over to the Telegram channel if you're not in there yet, guys. A whole lot going on. Last but not least, here's the website, guys. Type your email in here. The link is in the description to the website. This was the newsletter, the Sunday newsletter last week. We covered the banking crisis and how it is over and how the new bull market has been here and perhaps here for some time. A whole lot in here, guys, so make sure to check it out. And we are playing both sides of this tape, right? So what we're going to cover this week is how you can expect a turn in the markets and follow us along and follow along with us to play that to the downside eventually with protective plays, defensive plays, shorts, and more. So that's it for today, guys. See you in the video Sunday as well and in the newsletter. I hope you have a great rest of your day.